Welcome to Best Evidence. My name is John Titus, and today I want to look at Joe Biden's nominee to head the office of the Comptroller of the Currency, which is a very important bank regulatory agency. It's actually the oldest bank regulatory agency that started in 1863, which is quite a bit before both the Great Depression and the creation of the FDIC in the wake of the Great Depression, as well as before the creation of the Federal Reserve in 1913. So the OCC is a very old, and it's also a very important regulatory body for the banks. The OCC is becoming increasingly important as we move on, in my opinion, as U.S. money issuers, meaning both commercial banks in our monetary system and the Federal Reserve, are moving into crypto space, in particular with respect to stable coins, as well as the on and off ramp into and out of fiat currencies. I'll talk about those topics another time. For now, just know this, that something like 2/3 of all commercial bank deposits fall under the OCC's jurisdiction. So it's a very important agency, as I say. The OCC nominee in question here is Saule Omarova. She is a professor of law at Cornell who's actually been on Best Evidence before. I made a video called Has the Federal Reserve Been Keeping Two Sets of Books for the Last 50 Years? That was back in April of this year, 2021. Then I looked at a paper Omarova had written, really co-authored with 5 or 6 other authors. And I was really very impressed with some of the insights in that paper, and I still am, particularly about the Fed's balance sheet and in particular on liabilities on the balance sheet, which really aren't liabilities if you look at that episode. But in any case, for whatever reason, I reached beyond the 4 corners of that paper and opined that despite being an insider, Omarova seemed like, she was on the up and up. She was an insider, meaning she had advised a lot of investment banks while she was at Davis Polk, which, as you may recall, is Jay Powell's law firm where he cut his teeth, also where Omarova began her legal career. But that opinion, I must say, I rendered that before Omarova wrote a new paper about transforming the Federal Reserve from the partial monster that it is now into the total monster that Omarova envisions and that she wants the Federal Reserve to become. That new paper is called The People's Ledger. I'll get into it in a little bit. But in any case, what she wants and what she advocates in that paper is moving all $18 trillion in U.S. bank deposits onto, out of banks where they're sitting now, your bank account, my bank account, everybody's bank account. You add them all up, about $17.8 trillion. Omarova wants to move all those bank accounts onto the Federal Reserve's bank account or onto the Federal Reserve's balance sheet, where the Fed, she says, can then freely debit your account to cure inflation that the Fed itself is causing. Now, she doesn't admit that the Fed is causing, however, she plainly contemplates inflation in that paper and says, hey, easy enough to cure inflation. Once you've moved all people's bank accounts on the Fed's balance sheet, you just reduce the money supply by tapping into people's accounts and freezing their accounts. Don't give them access to their money. Just debit their accounts, she says. If you've watched Best Evidence over the last 15 months or so, you know that the Fed has affected both the creation and the transfer of retail trillions of dollars of retail money to billionaires, which is now causing inflation pursuant to a plan that was hatched by BlackRock back in August of 2019. All of that's old hat. I've covered all that in many, many videos before. The point in that all is that inflation is being ginned up and is being created by the Federal Reserve in this latest round of QE during the pandemic, or really since the onset of the pandemic. And now comes Professor Omarova and says, hey, you know what? We can cure inflation, which she won't admit that the Fed is causing, by moving your bank accounts to the Federal Reserve and debiting your accounts to keep the billionaire party going. And again, I've had a lot of videos on how the mechanics of that works. Probably the most recent and the most thorough of those is QE is the greatest sham ever. You can watch that, and I'll walk through how the Fed is creating reserves and affecting the parallel creation of retail bank money. In any event, that's what's going on, even though Omarova really isn't admitting to that in her latest paper. The latest paper, as I said, is called The People's Ledger. But given the scheme she's hatched in there about transferring retail bank accounts to the Fed's balance sheet and then debiting those accounts, the more accurate title and the more honest title for that paper would be something like sacrificing people's lives via ledger theft so that the crony billionaires can get even richer, because that's exactly what she's proposing with her scheme. My previous Omarova video was also before I saw her confirmation hearing before the Senate Banking Committee last week, where she told some straight up lies and gigantic whoppers under oath in her all-out attempt to become the nation's top banking regulator at the OCC. I was gobsmacked by some of her testimony, and I'm going to show you some of it. In short, my judgment about Professor Omarova being up and up was dead wrong. But no one bats 1,000, but I whiffed so hard on that one that I actually fell down at the plate. And so this video, in part, is me making an amends to my viewers and sort of correcting the record. To be clear, I do not trust a word out of Professor Omarova's mouth now, and I will not in the future. Though some of her writing, again, I stick to this opinion, with the very disturbing exception of her new piece, some of her writing is, it stands on its own, and it is outstanding. In particular, if you doubt me on that, go look at a piece she wrote called "The Merchants of Wall Street." She's done some really outstanding work. But this latest episode with the People's Ledger and with her testimony in front of the Senate, unbelievable. This is the last person you want is the head banking regulator in the U.S., or really any banking regulator at all. Omarova has absolutely no business as the nation's top bank regulator. But I will say it is easy to see why elite kleptocrats love her. And that's because her advocacy for unchecked Federal Reserve power has no decent human restraint whatsoever if you've seen her Senate testimony before the Banking Committee. It is thoroughly unbelievable. By way of all that background, let's look at Biden's nominee for the OCC. And at the outside, I want to address one other thing, and that's a lot of the media coverage on Omarova. A lot of it has centered around whether or not Omarova is a Marxist or a communist or a socialist, or do you call her a comrade? Whenever I hear those terms in the media, they're thrown around and debated, I instantaneously know that there is a grand theft of Main Street to benefit crony, crybaby, criminal oligarchs underway. That's invariably what happens. And what's going on whenever you hear socialist, communist, or whatever, there's a theft going on somewhere. You and I are going to be the victims of that theft. And that's true here. That's exactly what I found here. Those charges are absolutely ridiculous. They're actually, it's not that they're so much that they're ridiculous, it's they're totally irrelevant. And they're really, to charge Omarova with being a Marxist or a communist or whatever is a peccadillo next to the radical, and that's the term she uses to describe her own scheme. Those charges are just, they're laughable next to the scheme that she's proposing, which is the outright looting of you and your bank account via the Federal Reserve. So anyway, let's just dive right into the paper and take a look at it. And what I want to do here is I want to compare this Law Review article, which, as you'll see, appeared in the Vanderbilt Law Review, versus a couple of things. One, I'm going to compare statements in the Law Review article to the Federal Reserve's own data to check out some of the article's statements, which are, as we're going to find out, are there's a factual deficit in some of these statements. They are flat out wrong, and I'm going to show you that. And the second thing I want to compare the Law Review article to is Omarova's sworn testimony before the Senate Banking Committee, because there are some major discrepancies between what she tells the Banking Committee and what's in her article. We're going to see that too. But in any case, let's turn to the paper itself and get into it. Starting with what's the purpose of the whole paper? What problem is Omarova trying to solve with this latest Law Review article that she's written? And you can see here, right, I've got it up. It's a Vanderbilt Law Review article. It's called The People's Ledger, as you can see. I'm just going to cut right to it. And what she's saying here is we need to democratize. You see that right in the title. We need to democratize money. Let me get the highlighter on. And she's proposing to do that by, she says, the article offers a blueprint for a comprehensive restructuring of the central bank balance sheet as the basis for redesigning the core architecture of modern finance. So a pretty ambitious article by its own terms. And what she's specifically proposing to do, and she will tell you this up front, is she's proposing right here, this proposal, according to her, and this is accurate, would radically redefine the role of a central bank as the ultimate public platform for generating, which the Fed already does, modulating, which the Fed already does, and allocating, which the Fed does to a very limited degree, allocating financial resources in a democratic economy. In short, she's proposing the people's ledger. And what I want to do, I want to skip down a few pages again. I'm going to be cutting right to the most salient points in this paper. So just to sort of save time, I can't possibly go through the entire paper. In any case, she describes here in this page, this is the 5th page of the article. It is on page 2335. The first page of the article is 1231. That's just how law reviews are laid out. Beginning on odd pages, they show up in volumes. I'll be referring to the page numbers in the law review article so that when you check the link in the description box below and pull it up in PDF form, you can go to where I'm talking about. In any case, on page 1235, she gets into two things. One, she describes the current monetary situation, the monetary system in the U.S. She calls it a franchise-like arrangement. She's written about that elsewhere. The franchise-like arrangement. And in this arrangement, the Fed modulates, meaning it controls up and down, the supply of sovereign credit money, but outsources the economy-wide allocation of this precious resource to specially licensed and regulated private financial institutions, namely to banks. And right there, I'll just stop right there for a second and point out that when she's talking about sovereign credit money, that means reserves. And when she's talking about economy-wide allocation of precious resources, that's a separate monetary supply or a separate system of dollars called bank money. And I've talked about that quite a bit. But that's the current situation. And Omarova says the current situation is a real problem. And why is that? It is a problem, according to Omarova, because in this paradigm, there is no direct relationship between the central bank and the real people participating in the real economy. According to Omarova, that's a real problem. We need to correct that. That's a very interesting premise and very interesting problem that she goes on to solve. But in any case, the paper sets forth a way for people to have a direct relationship with the Fed. You just saw it there. She wants the people to have a direct relationship to the Fed, and according to her, that will result in a more democratic, small d democratic system of money in the U.S. So it's a very interesting concept. So let's see in greater depth what she's talking about and cut back to the paper. Okay, down on page 1236, where she fleshes it out a little bit more. She's going to change the asset side and the liability side of the bank balance sheet. And she says here, on the liability side, the article envisions the ultimate end state whereby central bank accounts fully replace, rather than compete with, private bank deposits. So the current system now, she's saying, of private bank deposits, that's going to get altogether jettisoned and is going to be replaced by central bank accounts. So in other words, rather than having your bank account at some place like Wells Fargo, your bank account would end up being directly with the Fed. She comes right on and says, in contemplation of inflation, the article proposes a mechanism for modulating the aggregate supply of money, controlling the volume of the aggregate supply of money via direct crediting, so we credit your account directly from the Fed, and in rare circumstances, debiting of your universally held Fed accounts. So there you have it. She's quite upfront about it, like, well, the Lord giveth and the Lord taketh away. Once you're at the Fed will give you money in your Fed account, and the Fed, when we have inflation, she says later on, will debit your account to control the inflation monster. And that, as I said, is on the liability side. She also has some rather interesting proposals on the asset side. The first two really aren't that interesting. I'm just highlighting real quick here. The discount window, that's number one. Seen that before. Really nothing to look at there. Also, securities issued by existing and newly created public instrumentalities. The Fed already issues, the Fed already issues securities as it is. She's talking about making new instrumentalities, and maybe that's new. But the real thing to look at here is the third proposal, where she's talking about an expanded portfolio of trading assets maintained for purposes of financial market stabilization. And that is what is of concern to us here. And I will just skip down and show you what she means by that. Quite a few pages down on the asset side, she's talking about the Fed directly intervening in the market. I will just search on FRBNY, Federal Reserve Bank of New York. And here we find on page 1275 what she is talking about. And she tells you right here, to this end, to the liability side, let me get rid of this. To this end, the Federal Reserve, Federal Bank of New York would establish a separate trading portfolio replicating as closely as practicable the market portfolio. In effect, this portfolio would be an index fund reflecting the proportional values of all financial asset classes constituting the financial market as a whole. And she goes on and says, the Fed would conduct its current daily tracking of the nation's financial markets. Okay, so really right there you see the Fed is already doing this. The Bank of New York is already, the Bank of New York is already looking at, it's monitoring the nation's financial markets. So what's new about her proposal? Well, you go down to page 1276, and here you have it in black and white. She tells you if a particular asset class, this is what the New York Fed is going to do under Omarova's proposal, if a particular asset class, such as mortgage-backed securities or technology stocks, rises in market value at rates suggestive of a bubble trend, the Federal Reserve Bank of New York trading desk will short these securities, thereby putting downward pressure on their prices. So she's saying on the asset side, the New York Fed is just going to come in and it's going to start shorting whatever securities it wants to. As far as democratic small d, there's no participation by the people. Her proposal is to leave it totally up to the discretion of the privately owned Federal Reserve Bank of New York and just let the Fed come in and start shorting securities willy-nilly. And that's her proposal. On the flip side of that, she says, conversely, the Federal Reserve Bank of New York can go long on particular asset classes that appear to be artificially undervalued, according to the privately owned Fed, in order to avoid unnecessary market dislocation. So there you have it. That's Omarova's proposal on the asset side. Just let the New York Fed go out and short some securities, whichever ones they decide. I'm sure they'll decide to short the securities of their enemies, and they'll go long on the securities of their friends. And that's Omarova's plan for democratizing the balance sheet of the Federal Reserve and getting the people. Apparently, this is for the benefit of the people, is just letting the privately owned Fed go out and do whatever it wants in the market, short whatever it wants to, go long on whatever it wants to, and that's Omarova's proposal for radicalizing or democratizing the balance sheet. To summarize, the proposal is to move $17.8 trillion in people's bank accounts onto the liability side of the Federal Reserve balance sheet, and on the asset side, let the New York Fed run hog wild by investing in some securities, shorting other securities, and if that causes inflation, fine, no problem. We'll just debit your account and reduce the money supply and cure that inflation monster. So while the New York Fed is privately benefiting billionaires, which it's doing right now, if that leads to problem, according to Omarova, no big deal. We'll just take the money out of your bank account, and that'll correct any inflation that the Fed causes. Okay, so that sounds a little crazy, right? Because it is crazy. And I'm not the only one who picked up on the insanity of that proposal. Evidently, members of the Senate Banking Committee were also quite alarmed by this. So I want to go now to the confirmation hearing, where Omarova begins, once she's confronted with her own words, to run away from her own law review article. And she's asked about that article for a proposal to move all demand deposits, all checking accounts, savings accounts, move them all onto the Fed's balance sheet. She's asked point blank about that proposal, and I want you to listen to her answer when she talks about what we're going to do once those things get moved onto the Federal Reserve balance sheet. Is this really your proposal? So let me just roll this clip. Here she is. There's a bit of a colloquy up the front at the beginning of this, and then we'll get to the question really quickly. So let's roll the clip.
Effectively ending banking.
Well,
My concern is
the phase that's more disturbing to me isn't necessarily ending banking as we know it, although that's exactly what would happen, but it is your phrase in which, and I'll quote again, this article accordingly advocates full migration of demand deposits onto the balance sheet. I read a lot of this paper, and it is clear to me that you are not referring exclusively to a central bank digital currency. You're talking about all demand deposits going to the Federal Reserve. Now, are you now saying you're no longer for that?
Senator, what I'm trying to clarify here is the problem this paper was trying to solve. The problem this paper was trying to solve was the fact that if we allow digitization of currency and the issuance of central bank digital currency without thinking through its implications, community banks and mid-sized banks will be put inherently in a losing position.
The purpose of the paper is to solve the problem of community banks and mid-sized banks being put in a losing position by digitizing the money supply. That is interesting, because I read the entire paper and I never once picked up on that. In fact, you didn't either, because we just saw that the point of the paper is to transfer all retail bank accounts onto the Fed's balance sheet and just debit them whenever they want. If the word community banks, I don't even remember seeing it. But there's no point in speculating about where community banks are or are not the point of the paper. Let's just go to the paper itself, and we'll do that. I'm just going to go here. I'm going to hit home to go to the very first page of the law review article. I will go in the search bar and just type in community banks and see if they really were the point of the paper. And lo and behold, here we go. You can see right here from the search bar, community banks appears for the first time on page 1265 of an article that started on page 1231. Here you go. For example, community banks and small credit unions could be licensed to offer pass-through Fed accounts on the same terms as and directly backed by deposits at the Federal Reserve. For example, so really the community banks appear in a cameo role, if that, almost mentioned as an afterthought. And you can see here in the sidebar that mention doesn't even occur until page 35 of the entire article. The notion that this community banks and mid-sized banks, and the same is true of mid-sized banks, by the way, they don't even appear, I believe, until somewhere in the 50s. Yeah, here you go, page 1283 for an article that started on page 1231. Mid-sized banks appear way down here. This is the first mention of mid-sized banks operating within diversified financial holding companies. Again, mid-sized banks are a total afterthought to Omarova. She mentions them for the first time in the 50s. Neither one, community banks nor mid-sized banks, are the whole point of the paper. That's just a straight-up lie. That's just ridiculous for her to say that and run away from her position. As I say, the community banks don't appear until page 35. Mid-sized banks don't appear until page 53. The purpose of the article has nothing to do with those institutions and everything to do with moving your accounts to be looted via inflation directly at the Fed. So, by way of that background, it is absolutely no surprise that community banks actually strongly oppose Omarova because they read the paper. They know what she says. They're not even mentioned in there, barely mentioned at all. But I want you to hear Omarova's explanation of why community banks oppose her nomination, because this is just unbelievable, her testimony on this. So I want to go over to this and look at her testimony when she's confronted and she's asked, hey, why don't community banks support you? Here's her testimony on that score.
There's been a lot said about why it would be obvious that Wall Street banks don't support your nomination. Why do you suppose independent banks don't? Because the independent community banks of America and several state independent banking groups also strongly oppose your nomination. It's not all about Wall Street. And so if you're such a pro-community banker, why do you think that they oppose you so strongly?
Senator, I'm with you on that. I wish the community bankers and their association, trade association, actually read more carefully what I've written.
She wishes the community bankers and their associations would read more carefully what she's written when we just saw that their understanding is 100% correct, and that in fact it was Omarova who was lying under oath about the very purpose of her own article. There's no misunderstanding at all. The whole paper is really about helping community banks? No, it isn't. Community banks, like I say, don't even make a mention until deep, deep into the article. But instead of honestly dealing with criticism of her work, Omarova sits there and lies about it and says that's the entire purpose of the paper, and then has the audacity to turn around and accuse her critics basically of being illiterate, just completely gaslighting them. You think about this. Do you really want this person who blatantly mischaracterizes the purpose of her own paper in charge of 2/3 of banking assets? You got to be kidding me. And that, by the way, is by no means the only example of Omarova running away from her own words. I want you to now listen to her explanation of her previous public statement she made concerning bankrupting small oil and gas companies to combat climate change. This is along the same lines. I want to play this testimony and listen to her answer on this one.
A recorded event earlier, you said you wanted small coal, oil, and gas companies to go bankrupt to combat climate change. The challenge here is that in my real life, I farm. I'm a small family farmer in eastern Montana. There could be somebody in a position that would say, you know what? The big guys are far more efficient. They do a much better job. Our food security would be better served if you went out of business. Now, there's arguments for that. I can make arguments on the other side, by the way, and damn good ones. Do you see how risky that is to make that statement?
I'm sorry, Senator.
That statement about taking certain industries and saying, you know what, I believe this, so we need to do it.
Right.
With one person making that potential decision, and you are we have oversight, but you're a one-man shop. Do you see how dangerous that could be?
Senator, I do not intend to advocate that kind of a position. That particular statement about oil and gas companies going bankrupt, as I said, that was taken out of context, and I actually misspoke. That was not well framed. My intention was actually saying was exactly the opposite, that we need to help those companies to get restructured.
That is unbelievable. Did you catch that at the beginning? She doesn't even understand the question. Tester's asking her, hey, do you see a problem with getting up there and playing God and picking winners and losers? She's like, no, I don't really see the problem there. And then finally it dawns on her, hey, maybe that is a problem. And then she says, no, I don't intend to advocate my own position, and my words were taken out of context, and I misspoke, and when I said those companies I wanted to bankrupt them, I really meant to help them. Unbelievable. How many internal inconsistencies can you cram into one paragraph? Remember, this is someone who trains people as richly paid attorneys to be advocates with words, sitting there telling you I misspoke, my words mean the exact opposite of what I intended, I would never advocate my own position. Unbelievable. She's not going to advocate her own position, which was taken out of context, and she misspoke. She knows exactly what she said, but again, she refuses to own up to it, and so she sits there and lies and says, oh, killing companies, when I said bankrupting companies, I really meant helping them. Unbelievable. And the hearing throughout was sort of like that. There's evasion after refusal to own her own words. Thankfully, by the end of that hearing, it looked like enough Democrats were on board to stop the nomination because, frankly, they looked disturbed by her repeated refusal to own her own positions and by evading questions and just outright lying and pointing her finger at other people and saying, oh, those people are just illiterate. They don't understand my paper. Yeah, they understand community banks don't show up until page 35. Unbelievable. All in all, it was a solid hearing. I'm pretty jaded, pretty cynical, but that was a really good hearing, in my opinion. The senators came. Here's the tell it was a good hearing. The senators came with their sheets, printed up. You'd see their sheets, questions printed up, and you'd see felt tip marker all over the pages. They had thought through their questions, and they were laid out really well. It was a very thoughtful hearing, very well done. A lot of the questions from different angles were reinforcing each other. I was very impressed by that. I give that hearing a B plus, which is a very high grade from my point of view. I can't give it an A though, because the biggest weakness in Omarova's entire paper, meaning the People's Ledger that was the subject of that hearing, was left untouched. The big question is that no one asked her, what possible justification is there for moving $18 trillion in bank accounts to the Federal Reserve balance sheet? Omarova says, well, in her paper, we'll see it in a minute, Omarova says, well, the Fed did step up with emergency programs during the pandemic, and it saved the day for Main Street. So what we need to now do is look very carefully at the answer Omarova sets forth in the paper, because it reveals a lot about her and her vision for the Fed and her vision for the OCC. Basically, it comes down to the Fed has done two things. Its emergency pandemic programs had a $7 trillion impact on the balance sheet, and specifically, number two, the Fed's role, its really new role as a credit allocator, proved that the Fed is indispensable to the functioning of the modern economy, and thus the Fed is primed to take over retail bank accounts. But let's get into it in her paper. I want to look at the paper itself, so there's no danger of me misquoting. I'm just going to write to her paper. And we will start here. Let me get to page 1246. There we go. Okay, done with that. Okay, here we go. Here is the section of the larvae article we're concerned with now. Section 2, the franchisor ledger at its limit, the impact of COVID-19. So that's where we're going to start. So your narrative really begins this way. Once again, the Federal Reserve, and once again, by the way, is a tell here that she's saying, we're having another crisis. The pandemic is a crisis along the lines of the global financial crisis. But once again, the Federal Reserve's balance sheet became the critical tool of saving the economy from collapse. Now, I don't buy that the Fed saved the economy from collapse in the global financial crisis of 08-09, but I'll accept that premise here. It still begs the question, well, if the Fed, saved the economy back in 08-09, and we are where we are now, and the Fed saved the economy in 08-09, and yet it didn't take over retail bank accounts, why is the Fed now in such a great position to take over retail bank accounts during the pandemic? If it's just another crisis, I'm still not seeing the justification for taking over the bank accounts along the lines with her proposal. But she gets into a little bit more and lays out her case, and you can see it here. The Fed began massive direct purchases of corporate debt and opened a credit line for municipalities, extraordinary measures that brought into sharp relief the central bank's fundamentally allocative role, which is normally obscured from the public view. So what she's saying is that during the pandemic, the Fed really put on a new hat and began allocating credit. Now, it had done that in the global financial crisis too, but this time it's really doing it to Main Street recipients, not just Wall Street. And so she has this next section where she sort of talks about it more. She says the asset side, whatever it takes. The Fed is doing during the pandemic whatever it takes to save everyone's hide. And she says down here, in the familiar crisis response mode, the Fed's balance sheet became the principal platform for injecting emergency relief funds into the lockdown economy. Okay? And then she goes on, and really, the Fed's injection of money, she says, divides into two types of programs. There's old programs and there are new programs. And she starts setting it forth here. She said some of these facilities replicated the emergency programs used to stem the financial crisis in 2008 and 2009. Okay? And then she lists those programs in a footnote here, 71. These include the primary dealer credit facility, the commercial paper funding facility, the money market mutual fund liquidity facility, and the term asset-backed loan facility. These programs, Omarova said, they're allocative, but they're old hat. We've seen them before. They're retreads from the global financial crisis. So what I want to do now is I want to look at the size of these programs and just see them in graphical form. I think that would help take a look at them here. So I've got this Fred graph up. I go to Fred a lot. It's the St. Louis Federal Reserve website. Has a lot of data. You can see from the headline or from the title of the paper here, I've got all the programs up that Omarova was just talking about. You'll notice that a lot of them have the two. It's the second. It's like I say, they're retread programs. I'm going to blow this graph up so that we can see it better. Here we go. Let me get that a little bigger. Here are the programs. Okay, let's just look at this graph real quick. This is 2003, back here, January. This gray bar here is the global financial crisis. This gray bar here is the onset of the pandemic. And you can see the Fed begins these retread programs. They actually peak out, if you look at it here, April 8th, 2020 at $86 billion. Let me blow that up so we can all see it better. And these programs, remember, these are retreads of the global financial crisis. When the grist of that crisis, the core of that crisis, 2008, 2009, was banks were bankrupt. And so these are really financial companies. This is really a bailout of financial companies. And I've put this purple color on it to distinguish it from the newer programs we're going to take a look at next that Omarova talks about in her law review article. And so next, Omarova says, the Fed also had these new programs. These are the Main Street programs, which provided money to regular commercial banks and municipalities. We saw that in her article. So let's look at her paper and see what she's talking about there. Okay, back to her paper. You can see, I'm going to draw a line. Well, you can see here, she gets into the new programs in the same paragraph. Several facilities, however, were established for the first time and aim to provide credit not to banks and other financial institutions like the Fed did in 08-09, but to a wide range of commercial businesses and state and municipal governments. And so she names these programs. You have the primary market corporate credit facility, the secondary market corporate credit facility, and a third one, the MLF, the municipal liquidity facility. But these are basically the three Main Street programs that Omarova was talking about. And she said this is the Fed's allocative role. This is where the Fed is stepping into the shoes of its allocative role in saving Main Street. So what we want to do now is look at those programs, look at the Main Street credit allocation programs, and I'm going to show you these in another graph. And this time I've got these programs, and you can see it from the title here. Here they all are in big type. The corporate credit facility, that, by the way, is both the primary corporate credit facility and the secondary corporate credit facility. For whatever reason, the Fed only set up one LLC in Delaware, I think, to take care of those. And then you've also got the municipal liquidity facilities. You can see them all here. But I want to blow up this graph. And I've got these that you can see in pink. And again, it's the same timeline on the graph. The global financial crisis here. It's the onset of the pandemic here. And you can see with these programs that the Main Street programs top out, they peak out at the very end of 2020 at, you can see there, about $68 billion. Let me zoom into that so we can see it. $68 billion. There we go. And those are the Main Street programs. And so I think it would be helpful. Let's now look at the old credit programs from 08-09 and the new credit programs during the pandemic, the Main Street programs side by side. And you can see them here. The old global financial crisis programs, really the Wall Street programs are in purple. Remember, Wall Street gets its money first, and then you see the pink. They get their money. So that really shows you those two different Wall Street and Main Street programs, the allocative programs Omarova was talking about side by side in this graph. And then the next thing I want to do is I want to add these two together so we can see how the Fed is allocating credit to both Wall Street and to Main Street to allegedly, according to Omarova, revive the economy. And here you can see this next graph, I've added them together. All the programs are here under one ginormous heading. I'm going to blow this graph up or expand it. And these are all the programs, the Main Street and the Wall Street programs together. But the thing to notice here is that these programs top out at about $105 billion on June 24th. And as of June 1st, those programs were right at $100 billion. Easy to remember. So early June 2020, those programs, the Fed's allocative credit programs, are sitting at $100 billion. Now, why do I mention that? The reason I mention it is I now want to look at what Omarova concludes from these Fed emergency programs. Remember, all these programs, Wall Street programs, Main Street programs, during the pandemic, they're all emergency programs. What I want to do now is I want to turn to what Omarova concludes from these programs, what she reads into what the Fed has done. Quite interesting. Let's go back over to her paper. Let's scroll down to page 1249, and let's look at her conclusion, Omarova's conclusion. Collectively, the Fed's multiple emergency programs, doing whatever it takes, remember that was the heading, to prevent an economic disaster, had a tremendous quantitative impact on its balance sheet. By June 1, the Fed's total assets surpassed $7 trillion. Huh, that's interesting. Emergency programs' tremendous quantitative impact on the balance sheet, total assets surpassing $7 trillion. You can see it right there. That's quite interesting because we just saw that that's a pile of garbage. That's actually a bunch of nonsense. You can see that by just going back to the graph we just saw. And contrary to what Omarova is saying, those programs had virtually no impact on the $7 trillion balance sheet. That's totally ridiculous. The impact, in fact, was about $105 billion. In other words, $0.1 trillion, not $7 trillion, as she would have you believe in this paper. That's completely and totally ridiculous for her to try to overstate the Fed's programs in that way. But be that as it may, she has completely overstated the Fed's programs. And you saw that from the aggregate graph. And in fact, I want to point something else out in this, that the Fed did not even provide $100 billion. The graph suggests that the Fed provided through its emergency allocative programs. The graph suggested it was $100 billion right at June 1, or $100 billion, maybe $120 billion total, whatever it was, is a drop in the bucket. But yet, let's look at what the Government Accountability Office has to say about that. Let me just take you over here. You can see here on the GAO website, Federal Reserve lending programs. All of these were authorized under the CARES Act, right at the beginning of the pandemic. And you can see here, here's what the GAO found, that about the programs added about $24 billion. That's how much those programs used. Not $7 trillion, not $100 billion, but a little more than 1% of what Congress can allocate it to those programs. And let me just blow this up so you can see it. How much did the Fed allocate for these emergency programs? About $24 billion to Main Street. That's what Main Street got. Nowhere near what Omarova is claiming. And so you can see here that the GAO has tabulated it up. Here are the programs. Here are the CCF, primary and secondary corporate credit facilities, Main Street lending program, municipal liquidity facility, and the term asset-backed security. All the facilities there. Grand total, $24 billion. But in any case, whatever it is, whether it's $24 billion or $100 billion, it was nowhere close to $7 trillion. And that begs the question of where Omarova got the $7 trillion figure from. How did that come about? And so I want to go back to, and I want to show you what's actually going on with the Fed's balance sheet during the pandemic. And so I've got that graph here. And what I've got here, the total balance sheet I have in blue. I'm going to blow this up again so we can see it. There we go. The total balance sheet is in blue. And Omarova says, the total balance sheet was $7 trillion. She's trying to claim that's the Fed's emergency programs doing that. But if you look, the emergency programs I've got highlighted down here in green, you could barely see them. They're so small. They're so tiny. And remember, that's $100 billion. That's what the Fed's saying it was. The GAO says, nope, that was $24 billion. So this is what Omarova is doing. She's saying, well, look, the Fed really stepped up. The Fed jacked up its balance sheet to $7 trillion and it saved the economy. And it was all, it was so important for the Fed to spare the economy. And she says it right here in her paper. Let's just go right to her paper. I can read it directly. These recent changes in the composition of the Fed's assets reflect the ongoing changes in the role of modern central bank, not only as the nation's primary money modulator, but also increasingly as its credit allocator. Put simply, the latest crisis, and this is where we get to the justification for the Fed taking over all retail accounts, the latest crisis made it no longer possible to ignore the fact that the central bank's balance sheet is an indispensable integrated platform for ensuring the functioning of the modern economy and not simply the back office support system for private franchisee banks. It's impossible to ignore how indispensable the Fed has become through its emergency programs, which saved Main Street's bacon to the tune of $7 trillion. There you have it. That's your justification for moving $18 trillion in retail bank accounts onto the Fed's balance sheet. This is utterly insane. It is a total lie, what she is saying. That is absolutely ridiculous. Those programs were a drop in the bucket. Despite what Omarova says, it was most certainly not the Fed who saved Main Street's bacon during the lockdown. Do you know who did? It was actually the Small Business Administration, truth be told, which administered the Paycheck Protection Program. And I want to take a look at that. I'm going to go to the PPP, or really to the SBA website, and I'm going to show you this. Here we are on the Paycheck Protection Program. This is part of the Small Business Administration. You can see here. Let's just scroll down, and let's take a look at some of the numbers that the SBA provides through, and this is what money the SBA provided through the PPP. And look down. Let's start with 2021 because we want to back this out. In 2021, the PPP, there was $278 billion in money approved and money that went to Main Street. And I know this money went to Main Street. I know a lot of people who benefited by, in a couple of cases, whose businesses were saved by the PPP. But in any case, 2021 saw $278 billion. And in 2020, to date, the program has provided a total of $800 billion. So if you back those out and you subtract, you can see that during 2020, the SBA, through the Paycheck Protection Program, provided something like $522 billion to Main Street businesses. And this is really what saved Main Street during the pandemic. It wasn't some $24 billion pissant amount provided by the Fed through programs, by the way, that no one's ever heard of. I don't know a single person who's heard of the primary market corporate credit facility or the secondary market corporate credit facility or anything. I know plenty of people who've heard of PPP. That's part of the ordinary parlance among ordinary Americans. Everybody's heard of that. That's who saved the economy during a lockdown, realistically. Certainly saved a lot of businesses. A lot of people I know benefited from the PPP. I don't know anybody who benefited from the PMCCF or the SMCCF or that bunch of nonsense. I suspect that was crony capitalists. But that's what Omarova is touting. That's her tout for why the Fed should be allowed to take over retail bank accounts to the tune of $18 trillion. Does Omarova ever mention the PPP? No, she doesn't. Does she mention the Small Business Administration? No, she doesn't. Why? Because Saule Omarova is on a jihad to have the Fed take over the retail money supply. Again, let's just look at this graph. I want to go back to the graph just so we can see the enormity of the lie that Omarova is telling. She's pointing to this huge blue thing here and saying, this is emergency programs. Look how much it helped Wall Street. They had all these programs to help Main Street. The Fed is now in the allocated position. Look at this. But she's not telling you anywhere in this article that these programs were a pile of nothing. They were next to nothing. I don't know anybody who benefited from those programs. But that's Omarova's case for why the Fed should be allowed to take over the entire retail money supply. The overstatement is done, in other words, by burying that tiny $25 billion of emergency programs inside of the $7 trillion balance sheet. And you know what? Remember, the $7 trillion balance sheet, as I've shown again and again, that was done, that affected the transfer of trillions of dollars to crony billionaires in the stock market. I've shown that time and again in this channel. I'm not even going to repeat it. The point here is the Omarova buried that $25 billion amount, that little green sliver on the graph, inside of the $7 trillion balance sheet. And you know what? That's not the first time Omarova hid one set of goods inside of another, not by a long stretch. If you look at Omarova's retail shoplifting arrest record, you'll see exactly what I'm talking about. Oh, you didn't know about that? Now, let's take a look at that. Here we go. I've got our arrest record right here. Let's just get into it. Here we are. You can see here we have a incident type. That's a retail theft. Let me blow that up real quick so everybody can see it really well. Incident type, retail theft. What went on? Well, on May 19th, 1995 at 7:41 on a Friday night, guess who goes down to TJ Maxx but one Saule Omarova? There she is. She goes to the old Westgate Mall. She goes into TJ Maxx. And, this isn't some kid we're talking about. She's getting her PhD. She is 28 years old there. Let's zoom in. We see that. What's going on? There you see it in black and white. Let's keep it going. Continue the arrest report and see just what happened here, how she pulled this caper off. Okay, this is a report from the police officer who shows up on the scene to finish off the arrest that was started by a TJ Maxx security agent named David Carlson. Upon arrival, I spoke with TJ Maxx security agent David Carlson. Okay, here's what he reports. The security guard observes the suspect, Saule Omarova, enter the store and place a large purse which she was carrying in a shopping cart. Carlson stated that Omarova attempted to conceal her actions by using clothing she had previously placed in the cart to shield the purse. So we have the smaller purse inside of the larger cart, and into the purse the stolen goods went. That is how that caper was pulled off, that theft. Carlson contacted Omarova after she left the store and identified himself. Omarova immediately requested the opportunity to pay for the items in her purse. Important for our purposes is that Omarova admitted to having stolen the items. Yes. And what items did she steal? Here you go. Here's her shopping list. Omarova nabbed 2 belts. Interesting. 2 different belts. If you look at the SKUs here, they're different. I say that because she also nabbed 2 bottles of cologne, which interestingly enough have the same SKU. Must have been intoxicated by the cologne. Went back for seconds on that one. She grabbed herself a pair of socks, and she went back and got herself 4 pairs of shoes. Manages to fit all of this inside of her purse, which, remember, is inside of a shopping cart. So she wheels the purse inside the shopping cart up to the checkout counter, casually puts the purse over her shoulder, pays for a couple items, bolts outside, gets busted by one very sharp-eyed TJ Maxx security officer. In any case, just like the theft inside of TJ Maxx, Omarova conceals one smaller thing inside of a larger thing. In her law review article, she conceals the $24 billion pissant Fed programs that allocate money supposedly to Main Street to justify the Fed taking over $18 trillion in retail bank accounts. Think about that. $24 billion of work the Fed's done, or money it's handed out to Main Street allegedly, although again, I've never heard of anybody who's even heard of those programs. $24 billion to justify an $18 trillion retail takeover. It's 1,000 to 1. You got to wonder why she's doing this. Saule Omarova is pretty much the last person on earth you want in charge of banks. So, my advice, call your senators, even if your senators are not on the banking committee. Tell them that this nomination absolutely must be stopped. There's no way you want this woman in charge of any bank regulatory agency, much less the top agency and the top position in the country. And that's really just that. This is absolutely the wrong person for the job. The Senate was absolutely right on that. That vote has not yet taken place. So get on the horn, call your senators, raise hell about this. This nomination's got to be stopped. We cannot have Sticky Fingers Omarova as the head of the OCC, and that's just that. Thank you so much for watching, and I'll see you next time.